All right, great answer. Thanks so much for that. We're going to take a quick break. We'll get back into Pro Picks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Dan, your Pro Picks, we've talked a lot about commodities, a lot on the metal side, and here you've brought us a couple of energy plays, as well as a mining play. But let's start on the energy side. Cheniere Energy, ticker LNG, so that tells us a little bit about what it's exposed to, liquefied natural gas. Why do you like it here? It's had a very nice run over the past year.
Once again, Cheniere fits our framework of infrastructure, owning infrastructure assets in this kind of macroeconomic backdrop. Cheniere, much like Keystone South Bow, has a take or pay model where the off-takers, the buyers of their gas, the business model is very simple. They take gas from the US, they own the infrastructure that liquefies that gas so that it can turn into a liquid form and be transported, put on a ship and transported. And then that gas is sent to countries all around the world that are short gas. So the US is long gas. Cheniere goes and liquefies that gas and owns the infrastructure to liquefy it. And then that liquefied gas gets sent to countries that are short the gas and need the gas for their power generation needs. And the way Cheniere makes money is they get paid a fixed fee, somewhere around $2.50 an MCF, give or take. And that fee is received on every molecule of gas that gets sold. And they enter into roughly 20-year take or pay contracts that can't be reneged on. And so you have this effective bond-like free cash flow stream that will last for 20 years and will grow as they grow their export volumes. So much like Keystone and South Bow, is the economy can tank and they'll still collect that fee. It's a take or pay. So we love it for this kind of environment where there's a lot of macroeconomic uncertainty. And so the question is, how do you get the growth? Well, here's where I think it gets really interesting. And here's the nuance that I think is being missed right now on Cheniere. Right now, everybody in the world wants to reduce their trade deficit with the US. And the reason for that is they obviously don't want to get tariffed. And one of the most productive, quickest, and easiest ways to reduce your trade deficit with the US, if you're running one, and if you need energy to run your country, is to call up Cheniere and say, hey, Cheniere, can we buy a whole bunch of gas from you and lock into a 20-year take or pay with this big aggregate amount of gas that we're going to buy over 20 years? You sign that contract, you take it to Trump and you say, hey, Trump, look, we've just cut our trade deficit. And it's a win-win because they cut the trade deficit with the US, so hopefully they get tariff less. And two, they get the gas that they actually need. Now, where it gets interesting is historically Cheniere, to get these contracts, they had to sit around the table and compete with the Australians. They had to compete with the Qataris. They can compete with exporters out of Africa. Today, it's a very different discussion. If they're sitting around the table competing with Qatar, Africa, and Australia, and the buyer's sitting there, they just tell the other countries to leave and say, we only want to do business with Cheniere because it brings us the added benefit of reducing our trade deficit with the US that is going to potentially reduce our tariffs. So they have 4 years here where they can go nuts and start signing contracts with very good rates of return. Now, those contracts, because it takes time to build this liquefaction capacity, they won't hit until, the early 2030s. But the nice thing is Cheniere, post the Russia-Ukraine situation, they entered into a huge amount of contracts then as countries stopped buying Russian gas and started buying more US gas. Those contracts are in the process of being ramped up right now. So they're in a hyper-growth phase from an earnings standpoint. We see them doing around $25 a share of earnings by 2029. But with the new vintage of contracts that they are likely to sign in the next 4 years for the reasons that we just discussed, we could see that earnings power potentially come close to doubling by the mid 2030s.
On
And
the same
so,
multiple?
you're looking at something with potentially $50 of earnings power that should trade at a 15 multiple. It's a high quality infrastructure asset. $750 stock. I'll do the math for you this time. 15 times 50
Now
is
I'm doing it. I'm
750.
learning. I've got my calculator. Okay, so 750 and it's a 230 stock.
Yeah, and again, no catalyst, Amber. A watch pot never boils. It takes time. But, I pitched this idea at C4K up in Toronto back, a few years ago, back when the stock was around $60. And I laid out a thesis very similar to this, not much different. And today the stock is around 230. So it's almost 4x'd since I pitched it. And I think it could probably 3x again from here if you just sit and wait. And the nice thing about it, Amber, is the visibility to these free cash flows are so significantly high. You're not making a commodity price projection. I see a lot of people saying, oh, well, these oil stocks will earn this much money at $70 oil. Well, that's great if oil's 70, but what if oil goes to 50? Or what if oil goes to 100? You don't really know what they're going to earn. But with these kind of companies where they have, fixed rate take or pay contracts that have 20 years in duration, you can model them almost down to the last decimal. And that's the kind of asset that we really like to invest in this kind of environment.
Well, that's one of three you brought to us. So let's get some explanations on the second one, which is Talen Energy. And this one's kind of traded almost like an AI stock recently, which has kind of worked both on the upside and the downside. It had a pretty significant pullback in the last couple of months. What is Talen Energy? What is the kind of AI exposure that people think it has?
Talen Energy is a nuclear power producer. We bought it out of bankruptcy. And when it came out of bankruptcy, it traded around $40 or $45 a share. Today, it's at around 200. So it's done very well for us as an investment. But we think the assets are substantially undervalued. Their core asset is 2 gigawatts of nuclear power in Pennsylvania. It's a plant called the Susquehanna Power Plant in Pennsylvania. And it's our contention that baseload power that can run 24 hours a day, 7 days a week, 365 days a year, very reliably, and has the added benefit of not generating any CO2 emissions, which is what nuclear does, that might be the scarcest and most valuable commodity in the world right now. You listen to every CEO at the hyperscaler level. They are panicking about where they are going to get their next gigawatt of power. And when you have companies with aggregate market cap approaching $10 trillion panicking on where they're going to get their next gigawatt of power, that's probably a moment in time when you should look at some nuclear power producers, because these hyperscalers don't want solar. They don't want wind. Solar, wind don't generate carbon, but they don't run 7 days a week, 24 hours a day, 365 days a year. Really, only nuclear, achieves these goals.
So do you want to express it through something like a Talen versus buying a uranium producer, which is, those have really pulled back as well.
Yes, we like Talen much better than the uranium producers. Nothing against the uranium producers, by the way. They're probably good, but we like Talen much better. Why? Well, we know what the marker is to build nuclear power generation in the US. The last time 2 gigawatts of nuclear power was built, and again, Talen has 2 gigawatts of nuclear power, so this is actually a really coincidentally good example to give. And there's only one example. There's no other instances of it, so it's the only example to give, was a publicly traded utility called Southern Company did a 2 gigawatt expansion of its Vogtle nuclear power plant. And it took them 15 years to do this and cost them $37 billion for 2 gigawatts of nuclear power. You can buy 2 gigawatts of nuclear power through Talen today They have a bunch of gas power as well, which is valuable, but just focus on the nuclear for a second. The enterprise value of Talen today is $12 billion. That $37 billion nuclear plant was done with pre-COVID money, before all the inflation, before it cost you $20 to get a latte at Starbucks. And so imagine what it would cost today. Now, there were some cost overruns and inefficiencies, but there always is when you're building these nuclear power plants. So on a replacement cost basis, it's very cheap. And we always like to look at, as you can probably tell, because we spoke about this with gold, we spoke about this with copper, for every commodity we look at, we like to analyze what is the equilibrium price of that commodity required for new capacity to be built. And so in order to do that, we realize that new baseload capacity, the marginal source of new baseload capacity is going to be gas-fired power plants. And so we studied GE Vernova. We've owned that in the past as well. And we did the analysis, just like we did on building a new copper mine. And we said, in order to generate a reasonable internal rate of return, IRR, on building new gas-fired power, you need about $70, $75, $80 power prices to generate a reasonable rate of return. And if we run those numbers in Talen, I'll save that punchline until the end because I want to give one more quick example. Microsoft, which is looking for power just like Amazon is, just like Google is, just like Meta is, they signed a deal with 3 Mile Island. Now, you'll remember 3 Mile Island, that nuclear power plant had to be shut down in 1979 because there was a radioactive leak where they had to evacuate all the children, all the women who were pregnant had to get completely evacuated from the area. 3 Mile Island became a dirty word. Microsoft comes and says, hey, let's restart 3 Mile Island. Microsoft Azure, brought to you by 3 Mile Island, coming to a theater near you. Let's restart this. At the time, power prices on the forward curve were trading at around $50 or $55 megawatt hour. They signed a deal, a 20-year contract at $100 a megawatt hour. And so we think the equilibrium price is around 75, but you could get data center deals done at much higher prices. But if we run our numbers at $75 a megawatt hour, which we think the equilibrium price for power is going to be because it costs so much to build these gas-fired power plants, which is going to be the marginal unit of new power, the earnings power of Talen is in the $30 to $35 a share range, and the stock's at 200. And, we think a business like this probably should trade at 15 times. So, 15 times 30 to do the math again is,
525.
It might go to 500.
I'm getting good at this.
But again, this is a critical piece of infrastructure that the world really, really, really needs. There was a great interview with Travis Kalanick on the All In Pod a few weeks ago, and they were asking him about AVs, automated vehicles. And he was like, it just can't happen at scale in places like California, because if we went to 100% AVs in California, you'd have to double the power consumption of California. And the California grid barely works, doesn't even work for what we use it for today. I mean, sadly and tragically, it burns down huge parts of California seemingly every 3 years. 6 years ago, it was Paradise, California that got burnt down. Most recently is LA. And when they do the forensics on the power infrastructure, they find that parts of the grid that caused the problems were over 100 years old. And so we are in desperate need of power and power infrastructure. And if you can buy existing assets that are producing today with the steel and the PP&E in the ground, that are already up and running for a big discount, a fraction of their replacement cost value, that is the kind of asset that you own in this regime change that we're going through that we discussed about very early in this interview.
Okay, so let's talk about how that fits with Ivanhoe, which is your lone Canadian pro pick here. Base metals run by Robert Freeland, which many people, of course, will know in Canada, and it has been under pressure.
Yes, I think you own that in a size that you can tolerate the volatility, but just own it and take it off your screen. Because I told you in my tech example that no copper producers can add supply right now because they can't make the numbers work at this price. The only company that can add supply economically right now in the world is the companies that are operating in the DRC and the ones that operate at scale like Ivanhoe. And we think that over time, Ivanhoe is going to go from producing roughly 600,000 tons. And to be clear, they only own 40% of that deposit. So it's really 240,000 tons attributable to them. We think that number goes from 600 to 900 to 1.2 million to 1.6 million. It's going to keep increasing by very significant increments, even if the copper price doesn't go up at all. And you get this really interesting volume growth story, but you also get upside leverage to the price. So I think what's really interesting here is that they are going to have volume growth, significant volume growth at today's price. And the algorithm becomes so interesting because let's say copper is at $4 a pound and it costs them $2 a pound all in to mine it. So they're earning a $2 margin. And over time, you double your production. But let's say, and so if you double your production, I think the share price should follow the volume growth. But at the same time, if I'm right that the equilibrium price for copper is closer to $7 a pound and your costs are still $2, then now your margin goes from 2, which is the $4 price today minus the $2 cost. That's where the margin is today, $2 a pound. If the price goes to 7 and the cost is still 2, now your margin is $5 a pound. So your margins go from 2 to 5. So you 2.5x your margins while you 2x your production. Now, what does that do to the earnings? That takes the earnings up 6 times. And stock prices generally follow earnings. So just give it time, size it accordingly, and let the compounding do the value creation for you.
I have to ask, just because we are running out of time, but you're a big jurisdiction guy. You've been talking about that. Are you comfortable with the jurisdictional exposure that you're getting, through the Congo and other parts that they're operating in Africa?
Interestingly, the answer is yes. And that's a very good observation and question that you have because it's the DRC. But interestingly, the answer is an emphatic yes. And I'll tell you why. Right now, I told you they owned only 40% of that mine. The other 40% is owned by the Chinese. And then the remaining 20%, they gave it to the host country. So everybody's aligned. So the Chinese are there, the Congolese are there, and Ivanhoe's there, 40, 40, and 20. Now, the growth projects that they're going to do, it's our view that they're going to partner with a US-based company. And so what that's going to mean is they are very smartly, and Robert's a really brilliant guy, they are ring fencing themselves geopolitically against geopolitical events. Because if someone comes after them for that mine, you're not coming after a little Ivanhoe, a little Canadian $10 billion market cap company. You're coming after the Chinese government on one side. And once they partner on their growth prospects with the US, they're coming after the US government on the other side. Remember when Trump said, or JD Vance said that if you, Ukraine, if Zelensky, you let us run your critical minerals, we're going to send our people there and that's going to be implicit protection for you. No one's going to touch you if we're there running your critical minerals. If you let us run your uranium and your nuclear facilities, that's implicit protection from the US. Well, this is the exact same thing. If you have the Chinese with a big ownership stake and the US with a big ownership stake, then I think you've ring-fenced yourself very well geopolitically in what might be a more traditionally difficult jurisdiction. And it also has the added benefit, and I didn't talk about this when I was talking about the growth profile, is it actually funds their growth. Because if they sell 40% to an American company on their growth project, that money comes in the door and they can use that money to fund their share of the capital. So it's a capital light growth profile, which is always the best kind of growth profile. That's why royalty companies do so well, because they don't have to spend any capital. So this will be a capital light growth profile where I think they've ring fenced themselves geopolitically in the best grade and best geological deposit of copper that I have seen in 25 years.
Holy moly, Dan, what a great interview. I feel like we got so many unique insights, even if we had to do a little bit of math to get there, but I appreciate it. Thanks so much, Dan.